India's favorite pizza maker is back in focus. Today we're breaking down Jubilant FoodWorks, the powerhouse behind Domino's, Popeyes, and Dunkin' Donuts, and whether it's cooking up value for investors at $576 a share. Let's start with the numbers. The stock trades around 576, very close to its 52-week low of 558, well below the high of 797. That's an important clue. Investors have turned cautious amid slowing consumption trends, but for value seekers, this could be a tempting setup for accumulation. Jubilant FoodWorks is India's leading quick-service restaurant operator, managing the Domino's Pizza, Popeyes, and Dunkin' Donuts brands. It's not just about pizzas. The company is expanding into burgers, beverages, and more, while entering smaller towns and cities. Its strength lies in brand recall, a vast delivery network, and a strong digital ordering platform, a true moat in India's fast-growing QSR sector. In FY26 so far, revenues have held steady with continued store additions, but profit after tax remains under pressure. Rising costs of cheese, packaging, and manpower have squeezed margins, though the company is gradually recovering, with EBITDA margins around 18 to 19%. Importantly, it's debt-free and still generating solid operational cash flows. Its ROCE, near 11 to 12%, signals steady efficiency, though room for improvement remains. Now about valuations. This is where it gets interesting. At nearly 160 times earnings, Jubilant trades at a steep premium to peers, but investors continue to pay for the brand's strength and long-term consumption story. Our intrinsic value estimate sits between 640 and 700, suggesting about 20 to 25% upside if operating leverage improves and consumer demand strengthens. Here's what makes Jubilant a resilient compounder: dominant brand leadership in the Indian QSR market, aggressive store rollout across multiple cities, constant menu innovation and digital transformation, strong cash generation with light debt. These strengths keep it on track as a long-term consumption play. But every story has its risks. Inflation in food and packaging materials continues to impact profitability. Weak consumer sentiment could slow same-store sales. Valuations are already rich, leaving less cushion for error. And competition from McDonald's, KFC, and new local QSR entrants remains intense. For traders, short-term entries between 560 and 580 could target 630 to 670, with a stop loss below 540. For long-term investors, gradual accumulation between 550 and 580 looks attractive, aiming for 750 to 900 over the next 1 to 3 years. This is a stock to build slowly, not chase quickly. In short, Jubilant FoodWorks remains a premium QSR leader, not a deep value stock. But for investors betting on India's growing appetite for branded food and urban consumption, it's a quality compounder at a fair entry point. Verdict: reasonably valued, 20 to 25% upside potential. Ideal for staggered accumulation and patient investors looking to ride India's long-term consumption wave. This content is for educational purposes only. Please do your own research or consult with a financial advisor before making investment decisions.